All right, everybody. Well, I appreciate you being here towards the tail end of the summer. We are grateful for your trust and for your support. This conversation is about cash management for entrepreneurs, but it really can apply to anybody as an individual, as an investor, and as an employee as well. And so today is going to be a fun conversation. We hope to make it interactive. We're going to share some data, some information. We'd love for you to, be willing to raise your hand, ask questions, and hopefully, share some resources amongst one another. As this conversation goes, we'll have you out of here within an hour, if not sooner. And thanks again for being here. Next slide. Yeah, just a quick reminder, as the lawyers advise us, that this is really educational and for informational purposes. We're not giving personalized investment advice, but take the information, put it into your plan, figure out what works best for you. If you have any further questions, don't hesitate to reach out to us. So, as many of you probably know, myself, Matt Rinke, I'm the founder of Illumination Wealth. I have my colleague, John Kenny, who's a certified financial planner with Illumination Wealth. He has become our cash management specialist. He's also a lead financial planner at the firm. And he's got some incredible information that we're going to share with you today. And just so you understand how we operate, we're really here to integrate your personal, your business, your entire financial life in coordination. And so everything's managed in context, in concert with one another. And our role is to truly enhance the returns across your entire financial life. And this is one component of that. How do we optimize the yield and safety of your own cash and hard-earned money? So hopefully y'all get to connect with John following this. And look forward to him sharing his knowledge with you here. So why is this conversation important for entrepreneurs? Why is this conversation important for everybody? I think for most people, we need to ensure that we're managing our cash appropriately. There are some standards, that we've come to learn and live by, and everyone's different. One of the kind of founders of entrepreneurial accounting, Greg Crabtree, has always stated that entrepreneurs in their businesses should look to maintain 2 months of their core capital that is accessible to them for cash flow needs. Now, this is beyond the day-to-day, working capital needs of a company, really like your emergency reserves. And so we know entrepreneurs, and we have clients that maybe have 2 months of capital on hand. Basically they're all expenses, 2 months worth of expenses on hand. We have others that have a year's worth of cash on hand to be able to, prepare for, the rainy days that may show up. And what happens is that this cash is just typically sitting there, and it's not necessarily doing the best and most productive thing that it can be done. Oftentimes this cash is sitting in bank accounts, sitting in checking accounts, maybe sitting in business savings accounts, really earning next to nothing. And for many business savings accounts, it's typically earning less than 0.5%, if that. And so we think that in times like this, it's a really interesting, potentially perilous economy that we find ourselves in. There's no reason that we shouldn't be optimizing all of our income creation opportunities, making sure that our money is as safe and protected as possible right now. Every dollar counts, and there's no reason that we shouldn't be treating our money with the most respect that we can. And so there are ways to do this safely now, different things that you need to consider to go about in doing it. So that's why we're having this conversation. And whether you have your own business and you're the CEO or the CFO, or whether this is just about your own personal cash, these principles apply. So I wanted to start this conversation around what's just going on in the economy. The economic landscape is really interesting and precarious, to say the least. Now, I'd love for John to share a little bit about some of the data that's out there and what the impact of this might be. So John, take it away.
All right. So the as most people probably know, there have been recession calls for really since the beginning of the year. It's been delayed. There's been a lot of skepticism and people wondering if it's been canceled. More likely, it's just been delayed. The economic data still is very strongly forecasting a recession ahead. So that's something definitely to be aware of. And a big part of that is the Fed raising rates. They've raised rates at one of the fastest rates in history and are now at very elevated levels. The other thing that we have to be aware of is typically when the Fed hikes rates like this, it takes about a year for the full impact of those hikes to make their way through the economy. So we're really at the point now where we're expecting just to start seeing the major impacts over the next 6 months to a year. So last thing then, there are risks on the horizon. It's a little perilous out there. The economy still does well. It's been very resilient, but the Fed is watching all of this and they're kind of sitting there with their sledgehammer because they do not want the economy to take off. They want to restrain it as a way to manage inflation. So the economy is trying its best to keep going, but the Fed is kind of keeping their boots on it. The one thing that we get out of this is great rates. So as Matt said, why not take advantage of this? The one thing that is a real golden opportunity.
And we'll be talking in a few minutes about the dynamics and what the Fed has done and how it can benefit you across various investment timeframes. And so with this perilous, economy, John, like, what are some of the reasons that you feel, beyond just what the news might say, like what are some of the data, what's going on out there that says, hey, there's a likely recession on the horizon?
Yeah, that's the thing. A lot of people have a lot of opinions out there. We try to look at the data, and here are a couple of the biggest pieces of data. This is a measure of the inverted yield curve, which is the scenario where short-term interest rates have risen above long-term rates. It's a very unusual phenomena. This is a graph from the Federal Reserve. Basically, it shows the long-term rates minus the short-term. When they're above zero, the long-term rate is higher, which is almost always the case. In rare exceptions, you get this inversion, and that shows when these graphs are falling below the zero line. And the other thing you notice is these gray bars indicate recessions. Every time you see these dips below where we get these negative yield curve inversions, there's always a recession following within a year to two after that. So you see here in 90, shortly after 2000, and then the Great Recession, 2008, 2009. Now we've got a very deep inversion here. You see these lines are falling well below, but it also looks, it's too early to be conclusive, but it looks like they may have peaked and started reversing. So definitely a troubling sign to keep an eye on.
And for those of you who don't know, when we talk about yield curve, basically the yield curve is a line that plots the interest rates that have different maturity dates. So the yield curve is basically saying there's an interest rate. Here's the interest rate that you could get for 1 year, and it might be 5%. And then the interest rate that you could get for loaning money for 10 years might be 3%, or it might be 7%. And so the inverted yield curve basically says that I could loan money today and get 5%, but I could also loan money for 10 years and get 3% per year for 10 years. So you're getting a higher interest rate that's inverted. You're getting more short-term than you are getting long-term. In a normal yield curve, you get paid. It's riskier typically to lend money for longer periods of time. So you typically get compensated more or have a higher interest rate if you're loaning money for 20 years versus 10 years versus 5 years versus 3 years. Right now, you're getting a higher interest rate for loaning money for a short period of time than you are for a long period of time. And that's the yield curve inversion. And so pretty much all these yield curve inversions have seen a recession follow. And so as business owners, we need to protect ourselves. As investors, we need to protect ourselves. We need to make sure that our cash is safe, that it's also earning and maximizing its income, as well as there for when you need it, because this recession or the potential for this recession is going to create opportunities for strong businesses. We don't want you to hide in a hole forever because of a recession that may not happen. It's not 100% that a recession happens, but we want to be prepared for the downside. And we also want to be prepared to take advantage of the environment that's presented. So that's also important.
Indeed, good clarification. And we'll have a graph of that yield curve in a couple more slides to further clarify that. So the second piece of really significant data is the leading economic indicators. This is a statistic, very rigorous set of data published by the Conference Board. And here again, this is tracking to a very negative level. July of 23 here just saw the 16th consecutive decline. And we're well below this red line here is historically, every time this indicator has gone below that level of about 4.5%, again, these gray bars, there's always been a recession following. So another warning sign, something to be aware of, keep an eye on.
Absolutely. And John, at the beginning of this conversation, you kind of touched on how there's this lag effect. And so what's happening now, the Federal Reserve has been raising rates and raising rates and raising rates over the last year and a half. At the same time, it doesn't necessarily mean that what they did a year ago or today is going to have an impact tomorrow. It takes time for these things to happen. And so can you explain how the Fed rate hikes might then impact this economy?
Yeah, absolutely. And that's, I think, one of the key factors in why people are thinking that recession hasn't happened yet, so it's not going to happen. Fed has raised rates all the way to 5% and everything looks fine. Problem is it does take time to work through the economy. For example, a corporation may have borrowed money for 2, 4, 6 years. Until those debts mature and come due and they have to roll them over into a new loan, they're fine. They're still paying 2, 3, 4% on their loans until they have to roll them over. But as each month goes by, more of those loans come due and more businesses have to start incurring these higher current rates. So that's an example of how that lag effect can play out. The other thing that happened is in this cycle, usually the Fed starts raising rates from a higher level. It may be at a nominal 2 or 3% Fed funds rate where they start raising. In this case, the Fed had rates all the way down at 0. And what happens is when interest rates are below a certain level called the neutral rate, there's this kind of brown line here in the middle. If rates are below that, it's a stimulative effect on the economy. When rates go above that, it becomes a recessive or contractionary effect. So when the Fed starts raising rates, it took them several months just to break that neutral line. So effectively, when they started raising rates, they weren't really stepping on the brake pedal. They were just easing up on the gas pedal that they had previously had to the floor. So just a year ago is the mark where those rates had crossed that neutral bound and started to become contractionary. And we're just a year out from that now. So we are just starting to get to the point where we expect these more and more of these lag effects to take hold and start to bite in the economy. The other thing it's important to be aware of is if the Fed stops raising rates, that doesn't mean everything's all clear. As long as these rates stay above this neutral line, this neutral interest rate, this is a persistent contractionary force. So if the Fed does nothing more, just leaves rates where they are indefinitely, that will continue wearing on the economy. More and more of those loans will come due and have to reissue at much higher rates, just creating more and more drag on the economy until, as the saying goes, something breaks.
Great data. And so with the Fed doing what it's doing, it's creating an environment that really hasn't been seen too frequently or relatively recently, and it's creating interesting opportunities in a dramatic fashion. And so when I shared with you a few minutes ago about like what the yield curve is, what we're going to look at here is what the yield curve actually is for US Treasury securities, the yield curve for US Treasury securities. Now, the red line is basically showing the yield curve as it sits today. So you can see at the far left-hand side, the red line is near 5.5, 5.6%. So we could basically buy a 1-month Treasury bill and earn 5.6%. That's near the highest, and that's the same for 1 month, 3 months, 6 months. Now, if you go out and you want to get a 30-year Treasury note, it's only going to pay us a little over 4%. So we can see the kind of the downward sloping nature of the current yield curve. Now, if we look down below, there's this green line. The green line is showing the average yield curve over the past 20 years. So when we look at that, you can see in one respect that it's upward sloping, right? For the government to borrow money for 30 years, they've had to pay on average over 3%. Whereas to borrow money from, the government to borrow money for 1 year, it was like 1%. So you can see that anywhere along the yield curve now, especially 1 to 5 years out, you are now able to get substantially more income at a higher rate than you have been at really any other time over the past 20 years. So way, way, way beyond normal. And also the fact that the short-term interest rates are much higher than they were than long-term interest rates. So John, perhaps you can share the magnitude of these changes.
This is really extraordinary. The short-term rates are 6 standard deviations above normal. This is a statistical measure that should only happen at once, 1 in a million times. So it's really an extraordinary opportunity. It's a crazy aberration, and this is what makes this a kind of a perilous economy at uncertain times. We're not sure exactly how this is going to play out, but it has negative repercussions for the economy, but in terms of earning yield, it's golden. And then this is the other side of that. If we look the lower end here, we're looking at the yield curve again in red, the long-term in green. And we're looking at the potential impact for what's called a reversion to the mean. If this red line, as typically happens after a recession, after these inversions, at some point these rates drift back down toward the mean, toward this long-term average, the green line. And what happens with a bond is, as interest rates are falling, the principal value of that bond is increasing. This is what happened in reverse over the past year in 2022. When rates were rising, bond funds were falling. They were losing principal value. But now with rates being at such high levels, the probability of falling is much, much higher than continuing to rise, which sets up the potential for an additional bonus beyond the yield that you will collect on a monthly basis. You also have the potential to collect a kind of a bonus capital gain. And the amount of that gain depends on the duration, how long the maturity of the bond is. So if we combine those effects, this blue line is really showing the opportunity over the next couple of years for each of these maturities across the spectrum. If you look out at the front of the 1 month, you likely get a 4% yield, which you'll notice is less than the current. And that happens because as these rates start declining, your 1 month is going to mature. If rates are falling, the next month that you roll over to is going to get a lower rate, and the next month a little lower and a little lower. So over the next couple of years, you might average 4%. Whereas if you start creeping out on the yield curve, say at 1 year, if rates do, again, from the red line, roughly 5.5% today, if they fall back toward the historical average, you would get a capital gain that would boost that yield up to roughly 6.5. Now, of course, there's no guarantee that this is going to come all the way back down to the historical average, but it's very highly probable that it will decline over the next couple of years, and you will have a gain beyond the nominal yields. If we go all the way out to 3, 5, 7 years, you see the potential return continues to increase. So there are really golden opportunities all along the curve. Now that rates have risen so high, we think these midterm levels are very attractive at this point. If rates did increase a little beyond where they're already at before they turn around, you might have a small setback. But if you kind of stay in the middle of the curve here, the potential setback is very modest. It's roughly the same as the duration of the bond. So say at a 2-year level, 2-year duration, if interest rates rose another full percent, the principal value would fall by 2%. So you're collecting almost 5, actually a little bit more than 5. So you would still be a positive yield. You just might have a little bit less. But again, over the next couple of years, it's very likely that it would be a net decline and a net gain. So these are just very rare golden opportunities here. And you look a little bit farther, out in the 5 to 7 year range, you're looking at potential of 10 or 11% for any money that's complementing an equity portfolio, for example. This is delivering equity-like returns with bond-like risk. So this is something you very rarely see.
So for entrepreneurs, for investors, there's different considerations about how you manage your cash. One of the important things when thinking about managing your cash is you need to make sure that you have the right amount of liquidity and assets that match to the time frame of your liabilities, right? And so we're not out here saying that everyone should go put their money in 7-year treasuries right now because of this opportunity set. We need to understand what is the purpose of the money that we have and how do we manage that money based on when you might need it and what your risk profile is, what your liquidity needs are. So in the short term, to have pretty much immediately accessible treasuries on the very short term, you can be generating 5.3, 5.5, 5.6% interest yields right now in your cash and have pretty close to immediate accessibility to that money. Now, the other thing that we didn't even mention about treasuries is that treasuries are not subject to state income tax. So if you see a treasury that yields 5.5, or in this example, 5.28%, that's really the equivalent of 5.8% when comparing to a traditional bank account or a savings account. A savings account rate at 4% is not the same as a treasury rate at 5.28%. It'd be the equivalent of a treasury at 5.8%. So I think you need to be aware of that. What's the tax equivalent returns of the income that you're generating? So in the short term, you could be generating 5% plus on your money, extremely safe and extremely liquid right now. Now, if all of a sudden we have other clients that might not need to have all of their money tomorrow, or to be able to wire out tomorrow. Perhaps they have invested in a fund that's going to have capital calls over the next 3 to 4 years, and they're willing to take some small amount of risk with that capital, knowing it's going to be invested anyways. You can then look to extend the duration, extend the time frame in which you're going to manage your cash. So instead of earning 5.3%, your yield might drop to 5%. So I might be sacrificing a little yield, but also to generate that potential upside on the appreciation if rates highly probably go down over the next couple of years. So that gives you the ability to get that capital appreciation too, and lock in that higher rate for a longer period of time than simply take the 5.3% short-term rate right now, which could go down as rates go down. So there's these opportunities that you need to think about. And then for other folks, you could even go out longer, right? I could think about this being equity-like returns. It's going to have more risk than keeping my money in immediately accessible short-term treasuries, but it has the potential to deliver significant returns on that yield curve inversion. So we need to be really clear about what you need your money for. Is this really working capital, excess working capital for my business? Is this just money that I haven't found an investment opportunity with that I could distribute from my business? We need to know that to then design how we're going to manage that cash. Take it to the next page, John.
Yeah, perfect. So one more thing I was just going to touch on here too. I'm glad you brought up the tax equivalent yield, because that is a major distinction between these treasury funds and virtually any other savings vehicle. And one more fringe benefit too, if we get this reversion and say in a midterm duration of 1 to 3 years there, half of that return might come from the principal increase, which is effectively the capital gain. So you've got your interest yield is free of state tax, and the capital gain portion then is can be a long-term capital gain at an even better rate.
Right. So interest income is taxed basically at your ordinary income tax rate. So for entrepreneurs and successful clients, their higher income, you could be paying 37% tax, federal tax, whereas capital gain tax is likely going to be 20% or 23.8% with some of the additional taxes. So significantly lower. So I think we all need to understand, like, what is our money earning now? And what are the options that are out there so that we can be putting our money into the best places? Now, business checking accounts, they yield nominal, right? We kind of, at the bottom, there's a little, Chase Business Premier, what you get for a relationship rate, 0.02% on your savings account. The average business savings account across the entire country pays 0.42%. So if we roll back the clocks to a year ago, the interest rates were still low. Maybe 2 years ago, you'd have certain savings, high yield savings accounts that would pay 0.5% when the interest rates were zero. These were lost leaders for the banks that were doing that, whether it was Capital One or Amex Savings Bank or Live Oak, whatever the bank is. Now the banks are making that money back. So their yields, what they're paying out is a lot less than what they can now earn by then themselves investing in treasury bills and the like. So we are thinking about you becoming your own bank where it's needed, where you can, and capture these higher rates on your own money. Now, everyone might have different relationship needs and lending needs from their bankers that might impact some of these decisions, which we're cognizant of, but it's important for you to know these things. So business money market yields around 4%. So if your bank lets you know that it's even available or out there, you might be able to get a money market rate from your bank at 4%. And all that is taxed at your ordinary income tax brackets. Now, depending upon relationships, one of the relationships we have is pretty much a fully FDIC insured high yield savings account, which will provide 4.71% on your first million and 4.16% on your next 24 million. So you can begin pretty significant rates on business savings in a fully insured manner. But then you take a step beyond that. There's money market funds that might not be at the bank, that could be in a different vehicle. Treasury money market funds might be paying 5.15%, which is that 5.7%. So now you think about it, hey, I can get 5.7% versus 4%. On $1 million, we're talking $17,000 per year of additional income for simply having your money in the most optimal place. And then there's treasury bills that you can buy individually, which have different levels of liquidity, but they're yielding 6.1% on a tax equivalent basis right now. And there's different administration needs when buying treasuries individually versus having a money market fund or the like. But I think it's really clear to see that if we are kind of ignorant to where our money is right now, it could be costing us a lot of money. And there's no reason to do that in this economic environment. We shouldn't be complacent with our cash.
Indeed.
So, John, maybe share a little bit about kind of bank accounts, brokerage accounts, what some of the differences are, knowing that if I'm investing in T-bills, my money's not in a bank account anymore. But maybe that's a good thing. Maybe not. What say you?
So there is an interesting trade-off between banks and brokerage accounts. I think most people have an impression that a bank is a safe place, and the FDIC insurance is typically what people think of that makes it so safe. But underlying that, banks are really inherently fragile. What they do is they take your deposit, they save 10% of it on reserve, and then they go loan out the other 90% or invest it. And so what happens to that? If they make bad loans, they can have losses. If they invest in temporary bonds, as is what happened with Silicon Valley Bank, and then those bonds suffer losses, they can quickly be wiped out of their 10%, and then anything beyond that, they start losing your money. This is why the FDIC came into existence, because so many banks were failing in this way. So as long as you're under the FDIC limit, you are protected. You could have disruption if the bank failed, but you are protected financially. A lot of people have money that is over that limit, and they are at risk. A brokerage account works in a very different way. By law, a brokerage firm has to take your funds and keep it in a segregated account. They're not going and investing it out. They're not loaning it. They cannot touch it. So they basically keep your money in a lockbox. Even if the brokerage firm fails, your money is still in that lockbox and they still have no access to it. None of their creditors have access to it. They cannot touch it. So your money is safe. The thing that we can additionally do there then is that's where we can invest in treasury funds or treasury bills directly. So you not only have the inherently more secure nature of the brokerage account, but it also gives them the flexibility to invest in higher yielding assets. So in fact, if you look at all these scenarios together, the trade-off, brokerage, the one thing that you do suffer is a little bit slower liquidity time. With a bank, you have instantaneous access. With a brokerage account, effectively you have 1 to 2 or 3 day access.
Yeah,
so it's a slight trade-off there.
Yeah, will you take it to that next slide?
Yeah.
So as we think about our money and what we need it for, how do we make sure that in our checking account we have what we need to provide for our cash needs over the next month, 2 months? So we don't ever need to think about the next paycheck or when's our client going to pay us. We've got enough capital, not with a line of credit in place, just enough cash in our checking account to provide for our cash flow needs over the near future. For things beyond that, for cash beyond that, it's how do we optimize the yield and have the accessibility to move the money back and forth. If we're planning and preparing right, we should understand next month, in 2 weeks, I have payroll, or I have my credit card bill due. If we are really on top of our money, we will understand our cash requirements each month to ensure that our checking account has the appropriate amount of capital in it to do what it needs to do. Beyond that, we should have money maximized and safe, the appropriate liquidity, maximizing its yield. So as John was sharing, what are some of the differences? Yes, with a bank, you're getting FDIC insurance. Your liquidity is pretty much immediate, for the most part immediate. Now you see some of these banks that put restrictions on how much you can wire out on any given day, or there's different cutoff times when you need to get money in. But for the most part, the access to your money in your bank is immediate. If you were going to go out and say, look, I want to move my excess cash, my emergency reserve, to a brokerage account to put it into a treasury and buy 1 month treasuries, the liquidity would work as this. One, you can set your account up to be a margin account. And if you have margin on your account, I'm not saying to use the margin to go buy, but when you buy a security, when you make an investment, it takes time for that investment to settle. So if I sell something today, the cash doesn't wind back up into your account for a day or two after, depending upon what you purchase. However, if I own if I own $1 million of treasuries in my brokerage account today and I sell it, I basically could withdraw half of my money today, 500,000. I could wire that out while I wait for that treasury bill, the actual back office settlement to occur, basically a day or two later. And then the day or two later, the remaining cash, the $1 million shows up in my account. It pays off the $500,000 that I borrowed, that I took out while I waited for it to settle. And then I have the additional $500,000 available to then move out. So you basically have half of your account value liquid day one, and then the other half day three. So this shouldn't be your working capital account. This should be your account that you can make a decision off of tomorrow and get access to your money, and then improving your yield in the meantime. So the liquidity is slightly different, which is why we need to make sure that you have the right amount in your checking, the right amount in other places to make the match, and to give you the liquidity that you need to do what you need to do. Now, we also, beyond just simply having a bank account, we are always thinking about defensive measures, right? Like we're playing a little bit of offense here with safe capital. How do we maximize our yield? But we always want to have flexibility, and we want to have access to capital in difficult times. So for many, you could have the optimal solution is I've got a bank checking account, but then I have a line of credit at the bank. And in many cases, that line of credit at the bank can provide overdraft protection in the event that something, you didn't think about the credit card bill and it overdrew you. Well, if you've got your line of credit, it can go to offset that temporarily while you work to move your brokerage account money back a day later. So yes, have your working capital, have your core capital, have your excess money maximizing its yield, have a line of credit accessible to you, business, personal, all these things. What can you do to layer in flexibility and security within your financial life? And that's the purpose of today's conversation. So, I'm going to open this up, to anybody. Feel free to raise their hands. I don't know if anyone has any questions. Feel free to put them in the Q&A box. Or if anyone wants to share at all what they are doing, how they're managing their cash, would love to hear from anybody. So one of the questions was, how do we find out where the best rates are on any given time? Someone emailed us beforehand. And so there's an online resource that we use, that we track. There's a site called NerdWallet. Many of you have heard of it. And they basically track the savings rates. And so each month they're reporting on personal savings rate, personal bank accounts, as well as business bank accounts. And they have a listing of, hey, these are the bank accounts these are the highest yielding savings accounts at various banks. So there's different business banks that might be online, might be brick and mortar, that provide high yield savings as well. So NerdWallet is a great resource for that. If somebody's interested in the high yield, fully FDIC insured account, we have a relationship with a couple of banks that provide unlimited FDIC insurance coverage. Now, with those accounts, they basically, your money's in a bank account and you have next day liquidity. So if FDIC is important for you, you're not going to be generating that same amount of yield, right? You might be generating 4.5% on your money, taxable money, versus 5.5 or 6% in treasuries. But then you get fully FDIC insurance coverage from that one account. And then we have other resources for clients, whether we're at Schwab or TD, and there's different preferred money market rates depending upon investment size. So there's a host of ways to be finding ways to maximize your cash and cash on hand. So hopefully those things help, and you're thinking about this. Well, so yeah, if anyone wants to raise their hand, by all means, please, love to answer any questions that you may or may not have. No pressure at all. I know we've already taken 40+ minutes of your valuable time and day. I'll give it one more minute. All right. Well, yeah, great. Good question. Finally seeing some Q&A. So a question, John, maybe you want to take this. Are treasury money market funds treated the same as directly buying treasuries from a tax perspective?
If the money market fund is predominantly treasuries, it should have the same tax consequences. So it should also be free of state tax.
Exactly. Hopefully that helps. Great question. Now, there are some funds and some mutual funds and investment funds that might have different types of securities in them. They might have some non-treasury government bonds or corporate bonds. The California tax benefit could be different if it doesn't have a certain percentage of its holdings in treasury funds. So something to be aware of. Another question that we had was, what are our thoughts about putting cash into Bitcoin? Well, that's a great question, and we love it. So the discussion that we're having today is about short-term cash needs and the variability, the volatility, the ensuring that my capital is going to be returned to me is of utmost importance in this specific conversation. If I need my money in 3 months to fund an investment, I want to maximize the yield on that investment over the next 3 months without jeopardizing my ability to make that investment. And so by utilizing the securities, the money market funds, as we're talking about today, would satisfy that requirement. As far as putting cash into Bitcoin has not proven itself to be a true store of value with the same, I do not know that in 1 month, my Bitcoin will be worth the same. If I put my money into a treasury for the next month, I know that I'm going to be able to, a 1 month treasury, I'm going to get all of my principal back. Bitcoin, my money could be up quite a bit. It could be down quite a bit. So for this conversation, not necessarily the same thing. Now, do we want to take cash and invest or speculate in Bitcoin? Would be a whole different type of conversation on how that fits into one's overarching investment plan. But I also know the appeal about Bitcoin is, in the event that the dollar devalues, that do we have some alternative currency that will be a store of wealth? And so I don't want to get those confused over the next, couple of months or couple of years. We probably need a whole nother strategy session about cryptocurrency. Great question.
Yeah, I would totally agree. I think the essence there is where you started, Matt. The Bitcoin is in the realm of investment, much more so than cash.
Well, appreciate the questions. Appreciate the time. Hopefully this was value added for you. We look forward to doing more of these. If you have any questions, you obviously can reach out to John or myself at any time. My email is matt@illuminationwealth.com. John's is john@illuminationwealth.com. We are here anytime and look forward to doing something like this again. And yeah, have a great rest of the year. Oh, good number question. Another question popped up. If I buy $1 million in 3-year treasury and I wait to sell it until it matures, I get roughly 5% interest. How do I get the extra profit if I sell early?
So what happens as a treasury is maturing, its duration is gradually declining. So if you buy a 3-year treasury and wait 1 year, it'll have a duration of 2 at that point. So if interest rates have fallen, then you will have earned capital appreciation equivalent to a 2-year duration bond. And you can sell it at that point, and you would reap that benefit. You would have earned the original 5+% yield for that first year. You would yield you would earn the capital appreciation equivalent to a 2-year bond, and you can sell it on the aftermarket and walk away with your gains.
So to maybe break this down into some numbers, if you buy, I'm just making if you buy a treasury bond that the par value is 100, and I'm buying a treasury bond today at 5% at 99. So I'm earning 99 today. I'm earning, yeah, I paid 99 today, and now the yields decline. Now the yields declined from 5% to 4%. That the 99 that I paid for that treasury bond maybe goes to 101. So now my 99 has earned 2 points because the prevailing interest rates are lower than the interest rate that I have. And so you get capital appreciation. So that's where, in order to make, facilitate this, is you've generated interest income, and the value of the bond is appreciated, then you sell it and there'll be capital appreciation. So good question. Very good question. Yeah, I would love to, one of our colleagues and former multi-billion-dollar fixed income colleagues, Ben, my uncle Ben, would love to share a little bit about risks and all this. So let's see if I can find a way for you to chat. Let's see. How can I turn this over to you, Ben? Hold on one sec. Good question. All right. Give me one sec. Ben, I'm struggling to find a way to let you talk. I apologize. Any bullet points that you'd like to share, please please let me know and I'll help to convey it. I don't know how I can add you as a host. I apologize about that. But we do have a follow-up question from about that. So if I buy a bond and sell it after 2 years, the chart shows an 8% return. That depends on how much rates have dropped. Is
that is correct? And what that chart is showing is the yield you would receive if the rates fall back to the mean, which is the long-term average. So if the rates here fall from 5% back to 1.5 or 2, depending upon the duration, that's when you would earn this corresponding yield. Make sense? If it doesn't fall all the way back, you would still have a gain above this red line. You'd have more than the interest yield. You might not have as high as this. So it does indeed depend on how much rates fall. On the other hand, it's also possible that if we get into a recession, the Fed could try to stimulate again, and they could actually drop rates below that green line. So you could potentially have even higher than that blue line on a net basis.
It's going to be an interesting couple of years to see how the Fed navigates, this environment. Undoubtedly, they're going to have a tremendous impact on the overarching economy, and we're seeing it, and people are experiencing, whether it's in residential real estate, whether it's in commercial real estate, it's going to have a profound impact. And everyone needs to build out their plan and cash management according to their needs. And no one's to say that you have to invest in long-term treasury bills because of the potential for appreciation. If it makes sense to just maximize your short-term yields and earn 5.3, 5.5%, by all means, do it. It's got to fit your plan, your liquidity needs, your risk profile. And everyone is unique and different. So,
yeah, indeed, we live in interesting times here. One more thing, just a quick note. These can also be mixed and matched, right? And I think Matt made a good point previously in matching the duration of the vehicle to the duration of your need. You might have short-term needs for some percentage of your funds. You put those in a very short duration. You might have other funds that can sit idle for a year or two, and you could put those in the midterm duration. So just match each bucket to get the maximum yield over the time horizon that you have.
right on. Well, sorry, Ben, that I wasn't able to turn the host over to you. I'm sure we'll have some good follow-up data to share with everybody from your perspective. And appreciate everyone being here. And so hopefully we can continue to have these conversations about timely and important aspects of our financial strategy in the weeks and months ahead. And we're here to be a resource. So if you need anything, don't hesitate to reach out, but we appreciate you being here. Thank you, John.
Thank you. Have a great day, all.
You too.